Hey guys, welcome to Agency Expose.
Hey,
I'm
Ken.
Ken Ott. This is Brad. How you doing, Brad?
Good. It feels kind of lonely today.
It is a little lonely today.
Why is it lonely? Why do I feel lonely?
The people that are watching on video would know.
Oh, that's right.
Yeah.
Our comrade Bob is out today. Unfortunately, he's doing well. He's feeling fine. He just, I think
Who knows?
I think he's trying to do business. I think while we're sitting here
right.
talking, he's actually making hay when the sun shines.
See, you know what? That's the secret. I forgot about that.
I forgot we somehow this. Yeah, you and I forgot we're in business.
Yeah. Yeah.
Not together, but we.
Yeah. It'll probably be a shorter episode then because he yaps a lot.
He doesn't yap.
I'm just joking.
Come on.
No, we'll actually be missing some of the psychology.
I know he always brings like the voice of reason and maturity to the discussion for sure, and so yeah. Well, it's going to be a very immature and
Shallow discussion.
Today.
It's unfortunate.
Yeah.
So get ready for it.
That's right. Well, today we have an episode that is I'm very interested in.
You're not interested in this. You are, and again, we have to put a disclaimer on this one because since Bob's not here, we're gonna get into some stuff that should not be misconstrued as advice.
Yes,
especially not investment advice.
Yes. So today we're going to talk about some financial stuff, but this is not financial advice. Consult with your financial professional. I am not a professional.
Yes.
I just play one on TV.
Yeah, but you were gonna say,
and you do too.
Yeah, yes, always.
Yes.
But you were going to say that I would say you're very good at this thing that we're going to talk about.
That's debatable, but thank you. I'm interested in it.
You're clearly a student of the markets, a student of the finances, and ever since I've known you, you've really been able to leverage what you have in a safe, conservative, but also effective way.
Yeah.
To do some really cool things with it, and I know that's a big part of how you and how that applies to your agency too, because I know you take that into that as well.
Yeah, for me, well, let's first unpack what we're going to talk about specifically.
Oh, we're just going to dance around the subject for a while.
Okay.
I'm just kidding.
Nobody really knows what we're talking about, probably
Go.
out there.
Please introduce it.
Yeah. So what do you do in your business? How do you leverage your business? And if you have capital on your books in your business, if you have cash on the books in your business, congratulations, number one. Number two, what do you do with that money besides let it sit in the bank account earning 0.02% when, of every estimate outside the feds is ever going to see a 7 to 12% interest. I mean, inflation rate this year, like you're losing money if you're just holding it. Like, what do you do with it to maximize your return on it? How do you liquidate it so that if you do need it quickly, how do you get a hold of it? A lot of times putting money into higher yield means that it's locked down for a few years. You can't touch it, or how do you get access to it?
And it's still under inflation rate by far, right? Things.
And what do you do if you have debt on your books, but you have cash or a bank or a loan or something, a business loan? How risky should you be with that money? You don't certainly want to lose it if you're borrowing it. But at the same time, you have to take a little bit of risk. And so what do you do? And what are some things that we do? And what are some things that we're looking to do? Again, we're not financial advisors, but you got to do something with it.
Well, as a business owner or leader, I think it's you have to know some of these things. We've talked about that before. Like, you've just got to be a student of finances and the markets and those kind of things. If nothing else, from just the standpoint of climate for your business.
Yeah.
But then when it comes to maximizing what you have, you're really losing, right? With inflation, you're actually losing if you're not doing anything with the profits that you have.
Exactly. And there's a lot of interesting things you can do with it, which is fun. And you're talking
about buying boats, right?
Not buying a boat.
Okay.
A boat?
A boat.
Do boats go up in value? Maybe
these days they do, actually.
Maybe a 1950s vintage boat.
The 2021s, everything goes up in value.
Oh,
2021, but yeah, probably usually not. I was joking.
You should have bought bicycles in 2019 and sold them during COVID. You would have doubled your money.
Yeah.
There's a lot of. I'll tell you about something I just did, and it's interesting. If you guys at all had studied the Enneagram, personality test. I'm a 5, and the 5 has issues. Like every person, like every personality in the Enneagram, they have issues, right? They have this kryptonite. It's a thing that that isn't, it's kind of like it's bad and good. So one of the things for me is avarice, and avarice, I didn't know what that was. I have a 6th grade education, so I have to look those big words up.
I don't know what that is.
Yeah, avarice is the fear of lacking something, especially time or money. So you don't feel like the future has enough time or enough money. So you tend to hoard those things, thinking that the future won't have any. You're going to run out. It's going to be depleted. And
time will be depleted.
Yes. Yeah. So you maximize things. And one of the things that I do is I tend to be more bent to try to make as much returns on my money as I can to maximize. And actually, I will put that over pleasure sometimes. Like, I think that drives my wife crazy because you got to live, right? You got to live while you're alive. And so I say these things like, you got to live while you're alive. But yet I don't really I look at everything as kind of like, well, are we going to be able to, have enough to pay for college and my kids' future and things of that nature? So it's not something that I worry about. Like, I don't feel anxiety about it, like negatively. I'm just proactively do things to kind of make sure that anything that I do has a return on investment. And it's only because I feel like the only way I can ever duplicate myself, you see, there's not enough time in a day. So the only thing I can do is duplicate myself, but I can't duplicate myself, right? Cloning hasn't got that far yet. And AI and machine learning hasn't got that far. So the only way I can duplicate myself is to make my money work for me. And to the point where the money makes more money than I can personally make as a human being. Mm-hmm. Like, if you can get there, that's kind of where my head is. Good or bad, that's where my head is.
I mean, I don't know that it's... So I have some of those same qualities, and I don't have the same personality type as you. But that idea of...
Thank goodness.
Yeah. I don't know. I don't know if you want mine. But no, that idea of not spending... kind of putting off the enjoyment, to the end. When we get here, we'll enjoy it. Or when this happens, then we'll enjoy it. That actually never happens. And I had to grapple with that over the last few years because I have people in my life that have taught me, mentors and those kind of people that you've got to enjoy things. You've got to celebrate, celebration, that kind of stuff, And when it comes to business and I would say achievement and specifically money and all that kind of stuff, I'm very similar, right? Like I'd rarely, I want to maximize it.
Yeah.
But, I'm rarely enjoying it.
Yeah.
And that's not a bad thing. Like I'm heavily, and I would say would you not say most business owners, most that I meet, I get to meet lots of entrepreneurs from that are doing really exciting things. Most of them have that mindset, and I don't think that's necessarily bad, right? It's just bad if it's out of balance because, I would say one of the things that drives me the most is stewarding what I have well, like maximizing what I have, and it's not necessarily because I want an achievement. It's not because I'm greedy or love money. It's just because if I have a resource, I want to maximize that resource.
Yeah, that's exactly how I feel. I don't feel like I love money, but I enjoy finding opportunities to take all. I mean, think about it, guys. We work our whole life for something called money that literally we don't have any control over. Like people really don't know. Most people don't know that in 1970, I think it's 71, we went to the fiat dollar, which the rest of the world did too, really. And central banks, we got off the gold standard. So the feds determine how much that dollar's actually buying power is worth. So we don't have any control. We work our tail off for something that the central banks and the feds actually control what the buying power is and what it's really worth. It's a dollar, but it doesn't buy the same thing. In COVID, we printed 25% of the total dollars in circulation. That means that your 401k went down 25% and you didn't even know it. The government, the feds, not the government, but the feds and the central banks went in there and just took it out. Boop.
Yeah.
They didn't know it. And so,
Does that mean, let me just ask
Yeah.
you this, right? In your opinion, does that mean if we didn't, let's say as businesses, increase our prices by 25%, that we're currently losing
Correct.
25%?
yeah, did you raise your price 25%?
No.
My clients would have said, no, thank you. If I raise my, excuse me.
Hell no.
Yeah, exactly. I'm like,
Yeah.
I'm like, hey guys, the federal banks made me do it. I have to raise my
Yeah.
prices 25% more because the federal banks did.
Well, it does happen. It just doesn't happen in a single instance
Correct.
like that, right? Because people are starting to raise their prices because,
Yeah.
employing people is starting to get more expensive. We hear a lot about that right now.
Yeah.
Or, buying houses or simply buying wood, all that stuff trickles up or down wherever you want to go, right?
Yeah.
And kind of levels out. So it does level out.
Yes.
It's just not in a single swoop. And it's best if you understand, I believe, that it does level out. So at least you know where we need to go. Like, okay, well, for this to level out, I probably need to be thinking about how do I increase my prices or how do I reduce my costs by this amount because we diluted by 25%.
Yeah. Little Jimmy and his $600 stimmy, his little stimulus, I'm just making a joke about it, but it's not really, they don't understand that we're all paying for that.
Yeah.
We're all we're going to pay for that at some level and down the road. And, how do you protect yourself? So let's unpack a little bit about things that we do, maybe even personally or in our business that, again, this is not financial advice. We're just a bunch of layman guys who like to keep our money.
Well, we're just sharing.
Yeah, and we think we're good stewards. I want to be a good steward with my money, and I know that for a business to be a good steward with their money, that's how they're going to survive times when it gets a little rough financially, and they're able to keep employees and do things. So it's really, for me, it's kind of like this idea that the business has to be financially healthy. And whatever that looks like for your business might be different than mine, but it has to be financially healthy. You have to be able to, go through a downturn or a season and still be around.
Well, we've talked a lot about, at least I talked about my philosophy on runway, right? And I like to have a year of operating capital available. That's a lot for a lot of people. I mean, that's more than a lot of people would suggest. A lot of financial people would suggest you do. But whatever it is, like, you need to maximize what you have so that you can go through the 2020. I know when we went through 2020, there were several months where it was very uncertain, because our clients, our businesses were freezing budgets and doing all these kind of things. And I think a lot of agencies experienced that. There were months where it was really uncertain, and if we didn't have that stability, then we may not have made it through that time the way we did, right? We may have needed to cut staff that we didn't want to cut and those kind of things, and have to rebuild, or at the very least, it would have been a much more anxious period of time.
Yeah.
Living paycheck to paycheck. And so you don't want to be living paycheck to paycheck as a business, just the same as in your personal life.
Yeah.
And so doing this gets you out of that. And again, it's not about the love of money. It's about, financial freedom and, having money is better than not having money for sure. And it provides stability for your people, your team, your family. And so we don't need to talk about why. Obviously, as business owners, you know why. But I think you really need to get into it. Some people are like, I'm not really good at this stuff, so I don't do it. Or I'm not really good at this stuff, and so I have someone else who does it, which is not a bad thing. But there might be some questions to ask about that person as well.
I think there's two different thoughts. I hear so much, even business owners saying, I'm just not good at money. Mostly not business owners, because typically if you're a business owner, you're probably decent at money, or you learn to be. But I think the challenge is that being good at money is one thing, meaning that, and there's also being a good steward and an investor. And so for me personally, I always look at two different things. I don't mind debt. If I can leverage debt and double that debt, let's say I've got debt for 5%, right? And I know easily I can make 10 to 15% returns with very little risk on that debt. I will sometimes do things to leverage. I wouldn't get myself in debt to the point where I can never pay it back, or I couldn't pay it back instantly with no problems. But I'm always looking at ways for arbitrage and for leverage. Always. That's just what I do.
Mm-hmm.
Look at, I can get that for 3%. I can make 20% in 3 months, 4 months, and that could also be in your business. So if you're looking to leverage some debt to go after new business that looks very risk-free, or you can increase a business and triple what you borrowed in just 6 months, why wouldn't you? So it's not just the income of the service that I provide that I'm looking at. I'm looking at how to even leverage other means. So
are there some rules on that particular side for you? Are there some guidelines that you abide by, personal ones?
Well, I personally do this a lot. In my business, I don't do it as much. One of the things I always tell people, businesses, especially small businesses, if you can, go get a line of credit from your bank. Get it when it's good times. Don't try to get it when it's bad times, because that's when it's hard to get. So first of all, do a few things. Pay $100 a year to fees to get a couple $100,000 line of credit, whatever size of business you are that you need, maybe more if you're larger, just to have in the wings. It's not like you use it. If you use it, you don't pay for it. Mm-hmm. But it's easier to get a line of credit.
If you don't use it,
if you don't use it, you don't pay for it. And besides maybe a small $100 a year fee, but it's harder to get those when the economy starts to go south,
or when you need it.
Yeah. So get it when you don't need it, and have it there and keep it there as a safeguard. You're gonna pay 5%, 6%, maybe whatever the interest rates are. I mean, at the times they're gonna probably go up in the next few years, but 5% is pretty cheap money.
Now, we advise, this is from personal experience and also my mentors, like, you should, if you're gonna get a line of credit, like, you need to know under what circumstances you would use it.
Correct. You have to have a plan for it.
Predetermined.
Yes, you can't go out and buy yourself a car.
You can't do that. I would also say you probably shouldn't use it to not pay yourself and pay all of your employees.
You should.
Like, if you're in that, you should not.
No, I would not use it to.
In those type of situations.
Correct. Unless you were going after new business that you felt like you needed.
An intentional step.
Yeah, intentional step to grow your business, but not as a defense in case things go bad, that you lose a client and now you're paying.
Correct.
Trying to keep the doors open with it.
Because
correct.
I've always been taught, and this has served me well, and this is what I tell people, is the business needs to live on its own. Like, if it is not viable, something needs to change. Bandaiding that with credit is only going to hurt you. No.
Don't get yourself in the debt to keep your doors open.
So if your revenue is below your cost basis, for a period of time or something like that, something in the business needs to change.
Correct.
It's like when you're feeling heat on your finger because you're touching the stove.
Correct.
You don't just numb your finger so you can keep touching the stove.
Yeah.
Right? It's telling you something and you need to react.
Correct. Now, when I said in case of downturn, I didn't mean to keep your doors open. I meant to, and it's not a bad thing if you know that you have business.
Right.
It should always be a positive decision. It should never be a negative decision with capital.
Right. There's no hard and fast rule.
No.
And all those are judgment calls. But I think the point is I've seen people get into debt trying to keep their doors open.
Yes.
When it's really probably not facing the hard truth of why is this business not working on its own right now? Yeah. Or has the market changed?
Yeah.
Has our product changed? Is it temporary? You've got to look at those things.
I would say that if you were to use debt, make sure as a small business that you can pay off that debt almost instantly.
Right.
And that you're using your cash to make more than what the debt cost. So with that being said, even though I'm not an expert at that, I don't really use it very often in my business. I do have a line of credit. We don't really use it. We've used it a few times just to kind of test the waters a little bit to see. But we do have it as a backup, and thank goodness I've never really had to use it. I mean, maybe I should use it though. Maybe it could help me to expand. But I've got to be prepared to have like you said, be very intentional, have a proactive plan with it. It's not a reactive thing,
Yeah.
So
So then you've got, so we talked, you talked a little bit about that. What about, now hopefully if, we've talked about profit margins before, and, I know agencies traditionally have low profit margins. They've got high costs traditionally, but my goal has been to be as close to the 30% profit margin as possible.
that's high.
It is high. Well, it's high for agencies, but
Yeah,
I would
it
not
is.
say it's high for businesses in general. Like, right? Like,
No,
that,
agencies, I mean, man, if you look at
but in
most,
the agency world, it is very high.
it is, yeah.
That's my target.
Probably over double.
Yeah, I know. Most are 10, 11, 12%. And I was always advised by my business mentors that you should be shooting for what other businesses shoot for, which is approximately 30%. And
Yeah.
listen, if you start to break down that number and you want to spend money on advertising and you want to spend money on innovating what you do, and which all costs money, by the way. I mean, whether it's time, money, that kind of thing.
Can I
right?
stop you really quickly? You talk about 30%. You're talking about after all of your business, all of the owners have been paid too, right?
Yeah.
Okay, so that's like
Normal salary paid.
Yeah.
Yes, this is not your salary in there.
Oh, your salary's not in that 30%.
No, I'm saying you don't take your salary out of that 30%. Like, this is net profit.
Yes,
Yeah.
after everything.
Right. So you pay yourself a good salary after everything, net. You have that. Now you may take a profit share out of it. I'm not saying, but like I'm talking about your salary that you live on is already out of that.
Yep.
That's what I shoot for. And we don't do it by like cheaping out on products and that kind of stuff. The way you do it is by innovating what you do. And I just find there's a lot of fat in it. But anyway, the point is if you don't shoot for that, you can't invest into the business to be better at what you do. You can't invest into marketing. And if you start to break down the percentages of what should I invest into marketing, what should I invest into innovation, what should I do into these things, you kind of need that.
Yeah.
It doesn't even go into the owner's pockets typically.
Yeah. No, I like that idea is that you start with where the revenue's coming from and making sure that number one, you're profitable at what your desires are in your company, what your plan is for growth. And at that point, I mean, the reality is if you're not making profit, then we should just leave right now because
That's exactly right. It's just an expensive job.
Yeah, exactly.
If you're getting paid a reasonable salary, but there's no profit involved.
Yeah.
In addition to that, then you've just gotten yourself into a high pressure job.
Exactly. So let's talk.
I was gonna look up real quick. I
go
think
ahead.
there's a book called Profit First. I'm pretty sure it's called that.
While you're looking it up, next topic I want to talk about, which is in line with what we're talking about now, is
listen to that book, Profit First.
if you do have profit, what do you do with it? Besides, I mean, or let's just say that you're a business owner, you're taking that profit personally, you're not leaving it on the balance sheet. What do you do with it personally, or what do you do with it from a business perspective so that there's a return on investment and that you're able to have some capital that's liquid that you can, if you do need it, you got it. Because a lot of times, like let's say I decide to invest in something that has a high yield, I can't even touch it for probably a couple years. I'm getting yield on it, but it's not something that I can touch, but I might need to liquidate it. How do I do that? What are some assets that some people do? What do we do? We Ken and I talk a lot about investments just off the record, just when we get done, we're hanging out.
Usually after this episode, we
talk about what we're doing and stuff.
I basically just pick Brad's brain on absolutely everything.
So one of the things that I do, this is really strange personally, but I got into, I don't know, for some reason I love vintage BMW motorcycles.
Yes.
And so now I own 3 of them. Yes, 3.
Because you're from Detroit.
No, I don't know why, but I haven't, my oldest one is a 1958. Anyways, they gain around 10% value a year.
Isn't it crazy? Yeah. Is that just recent, or has that always been the case?
Well, I've had my first one. I bought it about 7 years ago, and it's literally almost doubled.
Okay.
And in what its value, I just think it's just it's just rarity. So the older these get, the more rare they get, and so I don't think it's just these days. I think it's just gonna stay the course for a while. So there's a unique investment. It's fun because I get to ride these things. I ride them all the time. And at the same time, they're sitting in my garage gaining value. My car, which is a new, like a 2018, is going down in value every single day. It sits in my garage.
Correct. Yeah.
Right. It's going to, and so trying to find deflationary assets, I think, is really key during this time. And I think, what can you put value in that you know is going to either stay the course and have the same value or greater? It can be real estate. It can be unique things that you enjoy, that it can be like antiques, It can be cryptocurrencies and other types of funds, high dividend funds and things of that nature, where you just know that it's just going to go up in value.
Well, before you and while you get into that, I want to make sure there are a few boundaries that I take. I don't know about you, but like there's a few rules that I have. Well, one is you've got your wealth generator, right? Your income generator, which is the business, right? That takes your effort and it produces money out of it.
Yep.
It's not passive typically, unless you're just an owner and you step back for it. But if you're an operator as well, it's not passive. It takes your time.
Yep.
Right. So that's what you spend your time doing. You generate your wealth there. So now with that profit, I've always been taught, what I do is, there's a portion of that you're going to need, right? Let's say whatever it is, 3 months, a year, whatever you want to put away, and say, hey, this is my my bucket for the runway that I have, right? So we have our runway bucket. It's our operating bucket, and then anything beyond that, after you get into that, now we get into things that can be less liquid and less accessible, at least. In my world, I'm curious what you do. So you've got your runway bucket, which needs to be more liquid, right? Like you wouldn't put your operating bucket into real estate because it's not liquid, right? You need to access it, but you still want to maximize it. And then you've got the overflow of that, which is the let's just call it the preservation of that. It's the wealth that you've created that can go into deflationary assets and those kind of things that are not necessarily liquid and really are more for retirement, future wealth generation, that kind of thing, wealth preservation. Do you kind of operate that way? Like, right? Like there's a difference. Like you're not going to put your operating, runway into real estate necessarily.
Correct.
Right?
Correct. Yeah. So
how do you maximize both?
Yeah. There's a lot that I put in long-term, and that stuff I understand is long-term, and that stuff could be real estate. Personally for me. So, as a business owner, I don't have a cushy retirement plan for myself. I mean, I have to make
most probably don't. Yes.
I have to make my own retirement. And the reality is, I think that's the case for most people, even if you're employed by an employer nowadays. Your business companies are not taking care of employees like they used to, especially for their retirement and things. So you've got to kind of do that yourself at some level, or at least subsidize as much as you can. So I find myself putting things away for my more what I would call retirement, even though I don't know if I'm going to really ever retire. It's just down the road. That could be things like real estate. That could be things like, different types of
vintage
funds.
Motorcycles.
Yeah, vintage motorcycles. It could become things like cryptocurrency that you believe in. Down the road, it's going to be worth more. And then I always try to look at, it could be gold. It can be anything, right? That you feel is a trusted asset that you trust, that you feel is going to be valuable in the future. And it can be, anything that somebody is worth buying from you at a higher price, I think can be an asset. And so some things you hold and some things, And then there's the quick investment that you can need to liquidate, so that you need cash. So like for instance, Tesla this year in December purchased, I think around $1.5 billion of Bitcoin. And they did that as a way to hedge their money against the US dollar and put it in something that's going to hopefully gain value. But they also realized that it was a great way that they could liquidate instantly and get that cash back if they needed. In fact, their first quarter, they actually bought Bitcoin and they sold 200 million of it. And on their conference calls, their financial conference calls, they said they did that around 200 million something. They said they did that just to prove its liquidity. that they could actually liquidate quickly enough and get the cash back in their bank account if they needed to. And they just did a test just to see if it was an asset that was valuable. In that first quarter, when they came out their quarterlies, I think they made more money in their gain of Bitcoin than they did selling cars that quarter, right? So they see that as a revenue generator as well, but also they can liquidate instantly and get their money in fiat US dollars if they need to. So those are things that a lot of companies, I think, are looking into. They're looking into alternative ways. So I do a lot of cryptocurrency personally. I'm looking at putting some of my balance sheet in crypto. There are a few I would put into, and there's a few I would not put into it. And I would never put money into Dogecoin because Dogecoin is completely inflationary. They can mine as much Dogecoin as Dogecoin will be mined forever, and the volume of it will just continue.
That is the joke about it, right? That it is infinite.
Yeah. It's infinite.
I mean, not that and there are other infinite
it's
cryptos.
not a deflationary asset. It's not rare. It's never going to be rare. It's never going to be. And Bitcoin is. So there's 21 million Bitcoin that will be mined when it's finished. Right now we're at like 18 million. So we're getting close to being there. But the final one won't be mined until 2040. Well, in every 4 years, there's something called the halving with Bitcoin, where the miners can only mine half of what they used to. Every 4 years, it goes into half. So the amount of Bitcoin being mined today goes into half every 4 years. Right now, there's currently, for the next 3.5 years, it's about 900 Bitcoin being mined a day. It's way more than the demand. So the only way to buy Bitcoin, you got to buy it from somebody else selling it. You can't. It's not new stuff's not being mined and fast enough right now. That's Bitcoin.
So they're mining less. The demand is much higher than what's able to be mined.
So it's becoming more and more rare every single day, which makes the asset worth more, and that's why the prices start jumping up. If you look at, I always look at historical, not that the historical data proves the future, but there is a lot of rhyming with any historical asset. I mean, whether it's gold, whether it's soybean, commodities, it's all the same. And so I do a lot of technical analysis in that kind of area. And if you would have invested in Bitcoin once it was worth once it was worth anything to be traded, Bitcoin has seen about 200% a year after year. Some years it's gone down 50%, 70%, but the other years it's gone up, 1,600%. So, but if you just held on to it and do even dollar cost averaging, where you just put a little bit, let's just say you put like, for instance, I think it was in 2014, if you would just put $100 a week in or something in Bitcoin, you would have had approximately, I don't know, you can maybe run the numbers. I think these numbers are correct, but forgive me if they're off, but just the concept is you would have put in like $37,000 total, but the value right now would have been worth $2.2 million.
Yeah.
So a $37,000 investment right now would be worth $2.2 million if you just did dollar cost averaging into Bitcoin since 2014.
And what's the market average per year? Is it around 10%?
Well, like the S&P or something.
Well, like when they say like let's say the S&P or
I think the S&P is probably like between 13 and 17%. Okay. I don't know. I'm not a financial. I'd have to go back and look at the numbers.
I know. I've heard this from several financial experts, but the point is it's a lot less. But that doesn't mean you should do all Bitcoin.
No. Right. What I would say
that's where simple diversification and hedging yourself.
Absolutely, diversification is key. If you really done research on like an asset class, right? Whether maybe it's gold. If you look at gold and go, okay, I'm gonna do some hedging in gold because I'd feel like our economy is gonna struggle a little bit. I'm gonna put something into gold. I'm gonna put money into gold. Well, there's different ways you can buy gold too. You can buy it you can actually hold gold in your house or put it in a storage somewhere and hold coins or whatever. Or you can go on your trading platform or E-Trade or whatever. I use E-Trade. This isn't a plug for them by any means. There's tons of great ones. And buy a gold fund. So they hold gold and you're just buying into the fund. That's what I do because I don't want to manage real gold. So I do that to hedge, but it's definitely diversification is key. And that's where I like diversification. So whether it's buying, how much money you should put in cryptocurrencies, my belief is you should put 5% of your assets into crypto. That's my beliefs. I don't know if it's going to pan out, and I only buy certain crypto. I don't buy. I don't buy these really obscure altcoins that they're high risk. Depends on your risk. It's like stocks. I invest in companies that are really more risky, over-the-counter stuff, startups that are, SPACs. And then I also invest in blue chip companies like Ford or companies that I trust. And
so obviously
high dividend.
you're talking as an advanced investor for a long time, right? So, but if you're not doing anything, right, there's a spectrum here.
Yes.
Like the point is I think about it like this, like what is the simplest way, lowest risk that you can just do better than what you're doing right now, which may be something as simple as, I was going to say money market fund. Those are barely even worth it. But, high yield savings accounts, even getting you a little closer to that. Right now, they're like 1-ish%. It's better than sitting in the bank.
Well, I think anything's better than nothing. So if you're
better than nothing.
If you're not earning anything on your cash, earn something. At least they'll buy you a cup of coffee.
That's all I'm saying. That's exactly what I'm saying. I'll earn something. Like but like there's, as you get higher, as returns grow, risk grows generally,
Correct.
right? So I think the point here is like maybe just at the minimum, like your operating capital, like, and this is not advice, this is just how I do it. Like put that in a place that is low risk, that is getting something.
Yeah.
And then, you might want to consider, what I do is you might want to have a corporate investment account where you're just doing funds, right? So simple, low risk funds, market funds that are beating inflation or at least beating,
or at least
the quote inflation,
at least breaking even with inflation.
Right.
I mean, if you can just break even and with inflation,
because cash
that's
is
awesome.
This is where it hit me years ago. That cash is the same as owning a car.
Yeah.
Like I never thought about it that way. I always knew like you own a car, it depreciates like every year.
Cars can be funner than cash though.
Can't ride cash.
Depends on the car, but I mean, I like your Lambo.
Yeah, you like it, right?
Yeah.
It's in my head.
It's a non-traditional pink.
Great.
Yeah, I'm used to. I like the yellow.
Yeah,
ones,
thank you. It's very loud.
Yours is cool.
It's very loud. Both in
Ken
color.
doesn't have a Lambo that I know of, but he does.
I got a Jeep though.
Yeah.
But cash is like a car, and when that hit me, that cash sitting in your bank account depreciates just like a car does, essentially.
Correct.
Then I'm like, wow. So at first I was overwhelmed by that idea. Like I'm working, I feel like I'm stewarding well. I'm loading up here and
unless it's
now I got to figure this thing out.
Unless it's a 1964 911 Porsche, that might go up in value.
That goes up in value. I mean, it seems like everything goes in value right now,
and that's fun too.
Yeah.
You can have fun,
except for
seriously,
cash.
You can find really fun ways to invest your money that
you found
that
them.
Gains.
Yes, you found them.
Every time I ride that 1958 BMW, I think of thank you. I'm making money while I'm riding the thing.
It's great.
It's awesome.
It's so great. I love that. My point is like so cash depreciates. So you got to do something with it. Like if you have it, I mean, you're really stewarding it well, maximizing it is actually, you're actually losing if it's just cash. And when that hit me, and I'm not saying what to do, I'm just saying like when that hit me years ago, and I've always been in like sort of like the amateur investment community, but like when that hit me from a business standpoint, I'm like, wow, we really need to do something with this. And that's when we started acting on it and trying to act smarter with it. But then there's there are things that can just beat inflation, and then there's like the advanced stuff that you're talking about, which may be a percentage in crypto, or a percentage in gold, or a percentage in some of these non-traditional assets that NFTs, motorcycles, those kind of things. But you don't have to start there. Is the point? That's like just the point I'm making, right? Like you don't have to start by doing
small.
that.
I think the challenge is start small, because if you're a new investor, risk is going to feel, you're going to get nervous with risk. Like I do things now that I would have never done 15, 20, 30 years ago in my investment history, because I feel more comfortable with higher risk now. Yeah. Because I've seen the returns and I feel more comfortable with the decisions I'm making. So I may be higher risk, but yeah, take small steps. I mean, even putting your money into high dividend stocks, where you feel comfortable that if you did need to liquidate, that the price wouldn't go down that much on the stock price, that you wouldn't lose money on the stock price. I have certain funds that I do that they're paying 10 to 11% dividends, They pay
Right.
quarterly. So literally it's paying 10%. That's,
And
you
it's
know,
appreciating.
and it's,
Hopefully.
and hopefully, and the stock stays about
going
this.
up.
Well, the stock stays about the same. One thing too that I want to tell everyone, I don't, and I never knew this. I don't know why, but when there is an asset that you really trust, and let's say something happens. Let's say, for instance, during March of 2020, when I'm going to call it the C word because I think YouTube actually will deminimize you if you say the real word. Yeah. Anyways, when we had in the whole stock market and everything was hit, I mean, everything went down. We call that blood in the streets. So when there's an asset or if there's something that's pulling and everyone's selling, right? And there's blood on the streets and everybody's dumping an asset or dumping just the whole economy or the whole stock market dumps or even the crypto market dumps. When everything dumps and there's fear about the asset and there's fear about the economy and being unsure, you got to pull a Buffett. You got to buy, right? And so
you have to be ready to buy.
You got to be ready to buy. So you got to have capital to buy because when there's blood in the streets and everybody's yelling the world's going to collapse, that's when you buy. And that's when you see these great returns. And if you would have bought anything back in March of 2020, it probably went up almost 200% within 7 months. You would have made 200% on your money. You know, and especially if you believe in the company or believe in the asset, that's even better. And that's what you want to, you want to look out for those opportunities.
Every wealthy person I've ever met, mentors of mine, they all have a similar phrase, some version of wealth is created in winter.
Yeah.
I
like that.
And so you have to think about that. Like oftentimes we think in an opposite fashion as humans, right? We think, when winter comes, we got to hunker down. The truth is like, and that wealth and opportunity is created when things are booming. The truth is when things are booming, everything's expensive.
Exactly.
There are no opportunities, or there are very little opportunities. Exactly. Opportunities are less common when things are booming, And so you've got to wait and be patient and gain strength so that when things cycle, because they always will, right? When winter comes, you're able to act. And you're able to then act in the opposite fashion of what the majority of people are doing, because you're not scared.
Another thing too is that if you're investing, you have to take your emotions out of it. Number one, you cannot look at any assets if you're emotionally tied to something, and it's hard not to. I mean, I'm emotionally tied to a lot of assets.
I mean, you automatically get emotionally
for instance,
tied to stuff.
I like Tesla, and I bought and sold Tesla, and I made money on Tesla. I've also lost a little money on Tesla. I made more than I lost, thank goodness. But I'm emotionally tied to Tesla because I like the dang car.
Yeah.
I like Tesla, I like what they're doing. But you really have to take your emotions out of it. You have to look at it from what's the data say, what's the history say, what's the financial say in the company, how are they doing in the marketplace, and you really just got to look at pure data sometimes when you invest. And then this whole thing, you call it the winter. A lot of people call it accumulation time. So for me, I used to look at things like I invest in cryptocurrency. So for instance, take Bitcoin. I used to invest in Bitcoin, and I was cheering it on when it got to 60,000, and all of a sudden it dumped almost 50%, and I'm like, oh no. Down 50%. The problem is we look at things very short term. When I'm talking about short term, you're talking about weeks. So if you're in an asset that you're not going to cash out for 4 or 5, 6, 8 years from now, who cares about the short term? In fact, if it dumps in the short term, you should be cheering it on that it goes lower because it just gives you more time to buy. Well, more time to accumulate more of it if you really believe in it.
Yeah, I mean,
So if Bitcoin went down to $3,000, I'd probably come now. I didn't used to be like that, but now I'm like, I'd probably be ecstatic.
Well, when our favorite brand, let's say Apple, has a sale, we're like, sweet, let's go buy a new iPhone. But when the stock market has a sale,
correct,
or an asset has a sale, we're like, oh no, we don't want to touch that.
Exactly.
Right?
Oh, I'm not. There's too much risk. And then 6 months later, you're like, shoot, I should have bought it.
We want to buy when things go on sale.
Exactly.
Yeah, it is thinking the opposite. It's actually just thinking a little more with common sense, that to me anyway, because but we've been, I think, conditioned as human beings with some of these things to think in the wrong way, right? So we're buying when it's high, we're selling and freaking out when it's low.
Yeah.
Now, seasoned investors are not doing that, but the majority of people seem to, because that's kind of where your emotions drive you.
I think the average retail investor, which is really just us. I mean, I'm just an average retail investor.
I'm definitely not below average.
You know, there's this hyper sense of like, I have a friend of mine who, you know, from December, I was saying, hey, you know, have you looked at Bitcoin? And this was right when like the initial part of the bull run started. It was, we're already into a bull run of Bitcoin, and it was like at, you know, initially like at $22 or something like that. And then months later, I saw him again and talked to him. He's like, oh yeah, my financial investors keep on telling me to put a little bit into that, and they're into that, and blah, blah, blah. Finally, he says, I finally bought some back in April. I'm like, well, you know, you probably bought it at kind of another little high. It's probably going to get retract and go down 20 or 30%. Based on history, it's probably going to go back down 50% before it goes higher again. It'll go higher than what you bought it at, but you're going to have to wait for a little bit. You probably could have got it half that. But, you know, he didn't know the market. He doesn't know Bitcoin, doesn't know the asset. And he just heard the rumors and finally got into it months later. Well, months later for Bitcoin can mean a lot different than it was a month. It's an asset that changes very rapidly. So, you know, you really kind of got to do your research at some level. If you don't have time, then just try to find somebody that can really unpack it for you. Make sure you really understand each asset, because they're very unique. Every asset is really unique, whether you're buying commodities on something, whether you're buying gold, whether you're buying crypto. And different crypto is completely unique. Every crypto is unique. You know, some people think crypto is crypto. It's not. Bitcoin is not Ethereum, you know, and is not Dogecoin, you know. So, you know, you have to really understand those, and you have to understand the cycles and the rhythm that they have. And you have to look at past data to really see that of, you know, what it does. Yeah, they all have their own personality.
Right, and you really do need to be a student of it. And I think that's kind of what we wanted to do here today was like, obviously, this is not investment advice. Obviously, we're not professional investors. We're sharing some of the things that we do, but as business owners, I think it's important to be a student of these things.
Correct.
If you're a business owner or you're a leader of an organization and you don't want to be, unfortunately, you might be in the wrong position then.
You know,
you kind of have to be.
I tell our clients and I tell our employees that we are really like our business is like a financial investment business. We don't call it that. We call it a marketing and advertising agency. But we have to show return on investment. You know, the first thing you ask when you give your money to a financial investor is, how much should I expect in return? Are you going to lose my money or make me money? Same thing happens with us. And so you have to be a good steward of your own finances, your own business, to be able to make other companies money. Because we're not in the business. Our agency is not in the business to create digital assets. Though we do that and we do it well. Our business
for a reason.
Yes, our business is to make businesses money. It's plain and simple. Either long-term or short-term. Plain and simple. That's it. If it's long-term, then it's branding. If it's short-term, then it's direct response. Yeah, that's what we have. Yeah. You know, and so that's what we do. We're financial investors. And so I think you have to, you know, as a business owner, if you don't have that skill set, don't worry. You know, even people like me, I didn't have one. I went to art school. Right. I went to the creative side of advertising. I went to art school. I wasn't doing spreadsheets back then. You know what I mean? I was probably had crayons in my hand, and you know, I tell people I've got a 6th grade education. Don't use big words. Yeah. You know, but the reality is
we still try not to use big words with you.
Thank you so much. I don't like to be confused too much. So I'm just telling you that anybody can learn this stuff. You don't have to be a wizard. You don't have to go to business school. You don't have to be a financial wizard to grow into this. It just takes, like you said, what are the simple things you can do? It's just very simple concepts a lot of times and very simple moves. You try these moves out. You take low risk initially and you see what you do and what you did. The more, for me personally, the more that I put my money into something, then I learn about it more because I have skin in the game. And so the more I have skin in the game, the more I'm actually researching something. And then I kind of go a little crazy sometimes. And
now you could get financial advisors as well too, right? And again, this is not advice, but what I know about this is the best type of financial advisor is one that is not incentivized by selling you certain products.
Correct.
And those are called fiduciaries, I believe. Is that correct?
Probably, yeah.
I believe so.
Yes.
And it's a very different specification.
Yeah. They're just being sold what they're told.
Which means it's kind of like you just pay them for their advice. They don't do it. They don't have to do anything. Like they could tell you what to do.
Yeah.
And those are the type of people that you want, and that might be one way, to do this and to kind of get involved in this, and and if you're not comfortable, but I'd really suggest that if you're not doing anything like this, do it, because here's the other side of this, right? And we didn't even talk about this, but we touched briefly on retirement and the fact that retirement doesn't exist for business owners unless you make it. And it probably doesn't exist for anyone these days unless you really make it, because, and by making it, I mean, do it like intentionally invest into retirement. And so as a business owner, you'd need to be investing into retirement. And if you're whether you're a small agency that's just starting out, you're medium, or you've been going for a long time, I know people that have been building their company for the longest time, and they still haven't even, because they're doing everything, they haven't even thought about the retirement aspect of it. And so a financial advisor will help you do that, but all these things will kind of help you get down that path as well. And I think that's important.
Yeah. It's a challenge to learn what to do. I definitely think if you're doing it yourself, again, if you hire a financial advisor too, someone that you really trust that can help. I would, again, these are my recommendations. I'm not saying this is good or bad or I'm correct on this. I could be completely off base on this, but don't hire somebody that's too young in the financial advisor world. Don't hire someone who's just got out of college and now is working for somebody who's selling products, because they don't have the longevity of working in markets where they see the market change and go south and going through recessions and things. Try to find somebody who might be a little more seasoned, who's seen markets change over time, who's been around in the place for 30 or 40 years and understands, was born before we went to the fiat in 1971 or whatever we did it.
Right.
Make sure that they've have experience. Challenge them a little bit about what their vision is and for you, and what their overall sentiment is for different assets, and see where they stand. Are they just naturally risk takers? Do they really seem like they care about you, or are they just trying to put you into a plan that? And again, a plan's not bad. Diversified plan is not bad. And I'm not trying to.
But the fees eat away at the return.
I'm not saying that financial advisors are bad at all. I just found for myself personally that I like the idea of knowing what I'm doing with my money and seeing opportunities and being able to take advantage of them.
All I was saying there is, do more than you're doing right now, whatever it is. But there, with some areas of advisement, I'm not saying all. This is why it's kind of difficult to navigate, at least in my experience. You'll find all these kind of fees here and there, and they start to whittle away at that return, and they are pretty significant actually. They seem small, but they could be pretty significant. So look out for that. Anyway, hopefully this was helpful.
We should probably talk about this again. Maybe get a little more specific.
We could get deeper and more specific for sure. I mean, I know you've got
I don't know. Maybe it's too deep.
A wealth of knowledge.
No, I don't. But maybe it's too deep for the average person.
We'll see if we get some requests for it, and then we'll go from there.
Yeah, it's like anything. Sometimes when you spend so much time of your time into something, you become very knowledgeable that you start speaking the language a little bit, and it seems just normal vernacular, but it's not for other people, especially if you're not specifically doing this. And just take the baby steps. Try to minimize your risk, but you're gonna have to take a little bit of risk to see a decent return. And look at past things that in the past have produced over the last 30 or 40 years that have produced revenue or produced a return on investment, and talk to a lot of people that you trust.
Yeah. All right. Well, maybe next time we'll have Bob back.
Yeah.
We'll see.
Yeah, I'm sure next week. All right, Ken.
All right, man.
Well,
see you.
Have an awesome day.
You too.
Bye.
Bye.